Understandably, most of the world's economies are still in the process of getting back up, but the current numbers and state of things are still quite alarming to many, which begs the question, is the US destined to have a recession in 2022? And what does this mean for crypto? If you're one of the many who invested in this industry, then you better keep on watching to know more. First up, is the US headed towards recession? Many economists are warning of a recession, while Wall Street bulls insist those fears are exaggerated. An inverted yield curve and rising interest rates on the heels of strong inflation, 8.5% in March, have arrived, with COVID uncertainty and disruptions caused by Russia's invasion of Ukraine tossed in for good measure. Now the public is closely monitoring the Feds in line with the probable recession. According to Wharton's Susan Watcher, professor of real estate and finance, and Nikolai Rusanov, finance professor, the Fed has the resources to avoid a recession. Watcher believes that a rise in interest rates is the most likely cause of a recession right now, but that the Fed's actions thus far and predicted through the end of the year will not be enough to produce one. But according to Watcher, the key question is what it would take for the Fed to halt the economy. She believes that the US can avoid an induced recession if war and pandemic shortages resolve as the Fed predicts, and that if they do not, the longer inflation lingers, the more likely we are to enter a wage price spiral, necessitating the Fed to press the brakes hard. The US economy is quite strong at the moment, but there is indeed some risk of slipping into a recession, said Rusanov. Its length and severity would depend in large part on the Fed's response, and I expect it to do all it can to minimize the damage. Itay Goldstein, a finance professor at Wharton, is less enthusiastic. The start of the pandemic in March 2020, he observed, is an important component of the context for the current argument. The widespread assumption, according to Goldstein, was for a longer and worse recession. However, data analysis in 2021 revealed that the COVID recession was extremely brief. Furthermore, he stated that this was largely due to the government's and the Fed's fiscal and monetary involvement. These measures, according to Goldstein, contributed to the present inflationary increase, necessitating monetary tightening in the form of higher interest rates and a smaller Fed asset portfolio. He believes that this has the potential to trigger a recession, which is becoming increasingly likely as the US realizes that the inflation problem is worsening faster than expected and that the geopolitical situation is also contributing to these events, making inflation worse. So, how do all of these affect crypto? Right now, the American economy isn't doing so well. The US, despite a strong performance for American consumers, GDP dropped last quarter. Inflation is rising, markets are down, both salaries and personal savings rates are showing negative statistical indications, and of course, it has a significant impact on the crypto market. Here are some alarming concerns in the crypto industry. Next, everybody's stock portfolios plummeted. The Nasdaq has dropped 30%. Peloton and Zoom, two pandemic darlings, have plummeted by more than twice that amount. Ark and Tiger Global, two hedge funds that backed these growth stocks, were devastated. Sharp drops in stock prices can have a variety of effects on the economy, such as deterring investment and spending or causing a cascade of layoffs. It seems the crypto bubble has popped. Fear and rising interest rates are causing investors to sell off their investments, wiping billions of dollars from the market. According to one estimation, crypto has destroyed more than $200 billion in stock market wealth in just a few days. The bursting of the crypto bubble appears to be eerily similar to the dot-com boom of 2000, when the Nasdaq crashed and the ramifications reverberated throughout the economy, wiping out retail investors and lowering business investment until we entered a brief recession. If the crypto bubble burst were the only thing going on right now, I doubt a recession would occur. Except it's not the only or even most significant thing going on right now. And now, inflation is not only soaring, but also broad-based. According to the Wall Street Journal, inflation has eased, but the New York Times stated that prices are rising rapidly, approaching a 40-year high. Who is correct? They both are. Although the rate of price increases is decreasing, the overall amount of price increases remains high and painfully widespread. Some economists reassured frightened consumers a few months ago by pointing out that inflation was primarily driven by a few odd categories, such as used vehicles. That is no longer the case. Today, used car prices are falling as inflation has spread to service industries like restaurants and tourism. Gas prices hit their highest average nominal price ever this week. Inflation is undesirable for a variety of reasons. Debt continues to pile up while savings are falling. The US government handed most American households several $1,000s in checks from 2020 to 2021 to help them get through the pandemic. With most of the economy in shambles, many Americans clung to their stimulus funds, pushing the personal savings rate to a 60-year high. But now that nearly all of that money has been spent, the personal savings rate has slipped below the 2010s norm. The average household does not have much safety during an economic downturn, with markets falling, inflation soaring, and the Federal Reserve slamming the brakes on the economy. Instead, consumer debt continues to rise to new highs. Next, people feel a lot poorer than they did 1 year ago. Because unemployment is low and the labor market is tight, workers can simply quit their jobs and make new ones to make more money, a trend that is frequently referred to as the Great Resignation, which is a good thing. However, inflation is increasing every month, and raises are only given once a year. As a result, real nil or inflation-adjusted earnings are falling. Worse, the Atlanta Federal Reserve reports that wage growth is slowing, even as inflation continues to rise. This condition is untenable. On the other hand, former U.S. SEC chief economist also says that a recession is likely. After the coronavirus pandemic caused widespread shutdowns and unemployment, the U.S. economy staged a remarkable recovery on practically all fronts. Millions of jobs have been added to the labor market, and earnings have increased significantly, especially in lower-paying positions. However, rising inflation and interest rates have most Americans concerned that the good times will be fleeting. Are we going to have a recession? It's pretty likely, said Larry Harris, the Fred V. Keenan Chair in Finance at the University of Southern California Marshall School of Business and former chief economist of the SEC. He also added that it's extremely difficult to stop inflation without a recession. The Federal Reserve has indicated that it will continue to boost interest rates to combat current inflationary pressures. When interest rates are high, customers get a better return on their savings and must pay more to get a loan, which may cause them to borrow less. Rising interest rates, according to Harris, stifle spending by raising the cost of borrowing. As a result, less money flows through the economy and growth slows. Fears that the Fed's aggressive actions will push the economy into a recession have already sent markets down for weeks. Additional concerns, according to Harris, are the crisis in Ukraine, which has contributed to rising fuel prices, manpower scarcity, and a new wave of COVID infections. There have been huge things happening in the economy and enormous government spending, the former SEC chief economist said. When balances get large, adjustments have to be large. There will be a day of reckoning. The question is, how soon? As citizens, how can we cope with the coming recession? As much as all of these are scary, Harris also stated that there are a few ways one could prepare for the upcoming recession, which could also be applied as early as now, which includes the following. Streamline your spending. If they expect to be compelled to cut back, Harris advises that the sooner they do it, the better. That can mean canceling some costs you only want and don't need right now, such as subscription services that you signed up for during the outbreak. If you don't use it, you'll eventually lose it. Avoid variable rates. Most credit cards have a variable annual percentage rate, which means they're linked to the Federal Reserve's benchmark. So, anyone with a balance sheet will see their interest rates rise with each Fed move. Homeowners who have adjustable rate mortgages or home equity lines of credit tied to the prime rate will be affected as well. This makes it an especially good time to review your outstanding loans and determine if refinancing makes sense. Harris advised that if you can refinance into a fixed rate, do it now before rates increase even higher. Finally, invest any extra funds in I-bonds. These government-backed inflation-protected investments are almost risk-free and pay a 9.62% annual interest through October, the highest rate on record. You'll get a better return than a savings account or a one-year certificate of deposit, which pays less than 1.5% and has purchasing limits. And that concludes today's video about the current economic status of the US and how it affects the crypto market. Hopefully, today's video was very helpful to you. Before you go, don't forget to leave a like and subscribe to our channel with the notification bell on for more videos just like this. And with that, we'll see you next time. Thanks for watching.